I've already got the signal. Fantastic. So whenever you're ready, Samantha.
Hi everyone, I'm delighted you could join us. My name is Samantha Taylor and I'm an analyst at IFI Global. Welcome to our podcast and webinar on the Guide to Europe Part 2. This is a two-part guide we're doing primarily for US-based GPs and other third-party managers who are interested in developing their business in Europe. A more detailed version of what we are covering today will be published in our guide. Today, we will be providing an overview on distribution options for US managers, fund structuring, domiciliation options, and alternative fund regulations. We plan to leave approximately 15 minutes for questions at the end. As many of you will know, we have invited questions from the audience ahead of time, so we have a few already prepared. However, we would be pleased to get questions from you today during the session as well. If you would like to ask a question, please use the Q&A button at the very bottom of your screen. And we aim to finish at around quarter to the hour. So I will now hand you over to Simon.
Thank you, Samantha, and welcome to everybody, especially all of you. There's a few people, I think, a couple of people, at least in Canada, as well as a good number in the US, and indeed in a scattering of other countries as well. So we're delighted you are able to join us. One or two of you, as Samantha just said, have submitted questions ahead of time, and we will therefore, and we anticipate, by the way, we hope to get some more questions from the live audience here today. So we're going to leave what we hope is a decent amount of time for the Q&A session at the end. For those of you who don't know IFI Global, I think that applies to the clear majority of you, especially the managers, GPs out there. We are IFI Global is a research and media house based in the City of London meaning the financial district, and we have three monthly publications and one weekly, but we are bigger on our research side of our business than on our media side. And today we are announcing something for us, at least, is a very big deal. We hope it's going to be a big deal for our business going forwards as well, which is the launch of something we are calling IFI Global Interactive. I will say a little bit more about that towards the end of this presentation, but I will just mention now in passing that IFI Global Interactive allows our subscribers to ask us anything that they want on any articles that they come across in any of our media, and indeed also in our Guide to Europe, which will be coming up in a few weeks' time. We are in effect sort of outsourcing our research department and offering it as a tool for our subscribers. So that's very new and something we're announcing for the very first time today. Talking about today, what we're going to do is we're going to do a very quick recap of what we did in part one, in a sense, a bit like, you know, when you're looking at the sort of second series of some Netflix adventure. We'll just recap what we had in the first part, and then we'll get on to distribution, fund and investment structuring, domiciliation options available for third country GPs, especially those from the US, alternative and sustainable fund regulations, and as I have already mentioned, hopefully a good amount of questions at the end that we'll be tackling when we get there. I'm not going to spend more than a second on this because the good news is part one is on our website. Go to ifiglobal.com. You can either see the video version of that, or you can also download it as a podcast and just get the audio and see what we covered then. But in passing, let me mention, we think it's very important, by the way, that, and we don't think enough is done on this when people are talking about Europe to US audiences, is why is it that so many European investors are diversifying into the US. We have some figures that we presented last time on the really extraordinary growth that has been from Europe into the US over the last 20 plus years. And we don't think that's necessarily going to decline any time soon, because with all due respect to the many joys of the European region, it's pretty moribund, to put it politely, and nothing looks like it's going to get better anytime soon. So the investment opportunities are for many of us in this part of the world, elsewhere, particularly in the US. And despite maybe the tariffs and all the other stuff that's going on, we don't see that as necessarily going to be changing anytime soon. We also covered, this is all, last time was much more front officey overall, where we are seeing here in Europe the growth in terms of allocations to the private market strategies, especially strong in the family offices and high net worth category, which is very big in Europe, by the way. People talk about the pension funds. Of course, there's a lot of very sophisticated pension funds, but there's a lot of wealth here in Europe still, and particularly represented through the family offices and the high net worth market. And we talked last time about the growth in private market sectors. The one non-front officey side of last time was the fund governance, which we think that's often ignored or undervalued, the importance of getting the governance right on a fund. And we also talked about partner selection, which we mean by that service provider selection, and these things called MANCOs or third-party AFIMs. That was covered last time too. Right, so back to today. Let's get on to distribution. If you are coming to Europe, you effectively have three broadly different ways of doing it. Private placement, I don't think is talked about enough. I think the majority of the managers coming from the US and indeed from other third countries are using private placement. The problem with private placement is that it's not the same everywhere. And it's an important point to make again and again and again about Europe. It's not one homogenous market, even in the EU, let alone Switzerland and the UK, which are not in the EU. Private placement works very well especially in Northern Europe and in the Netherlands. And you can use it pretty well, although it's a slightly tougher regulatory process. But you can also use it in Germany, which of course is Europe's largest economy by some degree. At the other end of the stream, you've got reverse solicitation. It's not a distribution strategy, but it is used by a lot of managers coming here, particularly managers who are looking to put their toe in the water for the first time when they are entering the European region. There's lots been said in the past, and will doubtless be lots said in the future about reverse solicitation. Indeed, we got a question on it, even though we weren't covering it last time in the questions from the part one of this series. What I would say for those who don't know what it is, it's basically where a fund is offered only on an unsolicited, requested basis. It is difficulty. Again, each market is different in Europe. It's difficult to use, very difficult, if not impossible to use in France or Italy and Germany, and probably in the Club Med countries overall. It can be dangerous. It's not a recognized marketing strategy. That's an important point to make. But it can be used effectively, as I say, if you're starting out and you want to put your toe in the water. You do need a good lawyer and I would really recommend, if you're thinking about doing that, use a tried and trusted law firm that's drawn up many agreements in this field many times before, and that will protect your interests. But if you can, we've heard about this for decades, that you can fall foul of the regulator, but there certainly haven't been anything that's really got into the media, the financial media, the asset management media, about people falling foul of regulators. It probably has happened, but it's been swept under the carpet. But so it's there, it is available, provided, of course, you can demonstrate you didn't approach them, they approached you. The other one to talk about, of course, and we're going to come on to this in a little bit more detail in a second, is the EU passport. That means if you're going into Ireland or Luxembourg, for example, and you become fully regulated under AIFMD. You can avail yourself of the EU passport. Then you can do whatever you want. You can go wherever you want. And there are certain pension funds, even if you're only going to be looking at going to a couple of markets, who, if they're big, huge public pension funds, who probably would want you in the EU. However, they're looking at the people who are attending this discussion today. I don't think there are any of these big, huge. Those are the sort of the black rocks of this world that might be doing that. Where this is not largely speaking, today's audience. If you're in a smaller fund management category, you don't need to go through, unless you are really, for some strange reason, going to be marketing right across the European region. You don't need to necessarily domicile in the EU, or you're going to be going to a few of the very large public pension funds in various parts of Europe where they would like you to be fully regulated in Ireland or Luxembourg. But and we're going to get onto that in a bit more detail in a second. So let me then move on. I want to spend a couple of minutes talking about developments in investment structuring, which is probably a better term to use than fund structuring. But I mean both of them. There is definitely, we've been picking this up quite a lot in the last year or slightly longer, a trend away from, and this is, we're talking about in the private market space here, a trend away from using traditional structures into much more innovative type structures. This is one of the developments. It's sort of in the background, but it's happening slowly but surely all the time along the way. And I think it's a combination of reasons this is happening. I think what's happening is that managers are becoming more innovative in order to get business, and investors, particularly the tried and trusted alternative investors, are becoming more demanding and dictating terms in terms of what they want to get in order to make that allocation. The other thing that's happening, and this, again, I think we're going to see much more of this in the next couple of years than we have today. There is, I think, an influence on overall investment structuring by what is happening in the what we call the emerging asset classes. We follow those very closely at IFI Global, which is, by which I mean particularly the sustainable sectors and renewables. Some people call renewables not a sustainable sector. We do, but some people don't. And of course, the panoply of things that are going on in the digital asset management world as well. Those things are definitely affecting structuring, and we cover allocations from the family offices, endowments, pension funds, etc., very closely into these sectors. And you can see some of the quite interesting and unusual schemes that are being allocated to, not so much by pension funds, but definitely by family offices, endowments, and foundations and the like. So that is going on, and I would only think it's going to increase in the future. These figures are from a research study we did in the spring with a firm called ANC Advisors, which is based in Miami. It was for mainly US and Europe as well. So these figures aren't just Europe, but some of the results from this was, we asked LPs about their investment structuring preferences. The figure that surprises me here is the only 55% said they're investing in traditional pool investment funds. These are not these sort of retail funds. These are funds which were traditionally set up for institutional investors. That was, to me, surprisingly low. I wish we'd done this research 2 or 3 years ago, or 4 or 5 years ago. I bet you that figure of 55% would have been a lot higher in 2020 or something like that. Partnerships, that doesn't surprise me. The vast majority are allocating to whatever schemes they're in through partnerships. Managed accounts probably is higher than we would have thought, but this is, I think managed accounts have grown very substantially and almost gone retail, particularly in the US. And the other one that surprises me is co-investments, because I always thought of co-investments as being for very large pension funds with very large private equity houses, and that was it. And I wouldn't have thought of anything like as big as 27% of the kind of sample that we had. But I think it's grown quite a lot. It's come down in size, and there are a lot more type in very broad terms. I don't think it's necessarily always the traditional private equity type co-investment. I think it's a term that's been used more generically now and more broadly. And it's interesting that family offices and the like are doing those type of arrangements with managers. And I can only expect this kind of diversification and structuring will continue in the future. Now we're going to quickly rush through. If you are coming to Europe and you are looking at going to one of the established domiciles, the two in the EU, meaning the Luxembourg and the two just offshore in Guernsey and Jersey, you will find there's a very large range of types of structures and legal structures, types of funds and legal structures that you can use. These are all the ones in Ireland. Samantha, is there anything Samantha put this together? Is there anything you want to quickly comment before we
I should probably quickly note that there's two obviously main AIF types, the Quaif and the RAIF. The LTIF should also be noted because, it's been authorized by the domestic regime as well as the LTIF regulation. And then below we have the legal structures that can be used. Obviously, we go into this in much more depth within our advisory service and the guide itself. I have included investment company down there as an option. It is still available, however, it's much less commonly used, following the introduction of the ICAV in 2015, but it's still around. So all of that, again, is covered in much more detail in our advisory service. So moving into Luxembourg, which is the next slide. Again, we have the AIFs are available and the legal structures starting with the SLP below. Again, much more detail in our advisory service. Then we move into Jersey. Again, the same thing. I have grouped together the notification only, which is also referred to as the eligible investor funds. It also includes their unregulated fund counterparts. So again, you see there are a lot of legal structures within Jersey for setting up an AIF. And then moving into Guernsey. Again, the same comes for Guernsey as well. The interesting point to make about Jersey and Guernsey is the use of PCC and ICC cell companies, which are very, very innovative. Again, this is mentioned in much more detail within our advisory service. And finally, we have the UK. So again, the interesting point to note here is the introduction of the Reserve Investor Fund, which is newly launched as of March of this year. It's only really available for UK alternative investment managers. It's well suited for real estate assets. And again, below we then have the legal structures that can be used to set up those kind of AIFs. And I think that is it for legal structures.
Thank you, because I think we have some real estate managers following this call today. And by the way, it's been fantastic for iFi Global to have Samantha, who's got not only an undergraduate degree in law, but a postgraduate degree in law. So that's one of the reasons why we can now get into all this technical stuff in a way we didn't do before she joined us. Yes, sorry, Samantha, do you want to, no, it's me, sorry. This is, in quick summary, we think anyway, the most important directives, the most important regulations that are available in Europe. And I'm sadly old enough to remember when UCITS came in, which started the whole thing off. That's the retail thing. However, there are things called alternative UCITS, but they are designed for the retail market. We don't need to say anything more than that. They started all the way back in the 1980s. That's a shockingly long time I have been around to see the whole thing. And then we have AIFMD, which was a big response to the 2008 financial crisis. And actually, if we had more time, I could give you a long lecture about one of the reasons why the UK is outside the EU now was the reaction in the City of London from the private equity and particularly the hedge fund managers to that regulation and the fury it generated when it came along, which came out of the blue from a London point of view, that Brussels was planning that. We have a derivative of AIFMD2, which is a clearing up exercise. I've already mentioned NPPR, which is the private placement thing. EU VECA, Samantha, is there any point in saying anything about that right now?
It's just a cross-border marketing regulation for private equity and venture
Right.
capital funds.
The ones you really do need to bit MiFID, which is very important and very technical indeed, highly complex. I've been spent far too much of my life listening to MiFID discussions, and I don't propose to get into that now. Again, as Samantha was saying, we now offer if people have questions on this, come to us. We like to think we can answer them and/or pass you on to a law firm that can do it, in much more detail than us. But we have some knowledge on that too. The ones that really do matter are the bottom three here. The cross-border distribution directive, which came in a couple of years ago, I think it was, Samantha. And then we have MiCA, which I think is the first classic EU. The one thing the EU does lead on is regulation in every walk of life, including when it comes to financial regulation. So we had MiCA, which is for crypto and digital assets, all the way back in 2023. Again, I haven't got the time to get into this now, but come to us if you want some questions, if you have some questions on MiCA. And very, very, very important, and I think there's some sustainable managers on this call today, is the SFDR, which has been around for a couple of years too. And there's three categories, Samantha. Just quickly, please tell us what they are again.
Yeah, so SFDR applies to all asset managers. So you have the Article 6, which is, a fund that does not promote any ESG or sustainability objective. Article 8, which is a light green fund. And finally, you have Article 9, which is a dark green fund.
And very difficult to get the full classification for 9. Again,
we do have a couple listed in SII, but there's not many.
Yeah, it's very difficult to get. And it is, I think if you do get it, it's certainly very helpful for marketing your fund in Europe. But it's the hoops you have to jump through to get that is certainly very tough. Again, come to us and we can answer questions on that in more detail. Now back to other subjects, fund domiciliation. With the possible exception of Bermuda, because it's unfortunately for Bermuda, it's now so small now, but all these other jurisdictions will have funds marketed in Europe. Far less these days the Caribbean ones, meaning Cayman and BVI, but in comparison with where they were in the past, most people, if they are going to be availing themselves of AA, the passport, etc., they'll be coming to Dublin, Ireland or Luxembourg. And by the way, something I should say in passing, you don't need to move lock, stock and barrel. You can be in San Francisco, Chicago, Dallas, wherever you are, and you can, and lots of US managers are doing this, by the way, join a third party AIFM or a ManCo in either Luxembourg or Ireland, and then you are piggybacking on the regulatory entity that is already set up there, and you have to jump through a number of hoops to do that, and it's not necessarily cheap to do that either. But then you get the distribution. You get the biggest benefit for doing that is you get the distribution inside the anywhere you want to go inside the EU. And I know a lot of US managers over the last few years, not just US managers, UK managers, Australian managers from everywhere have been doing that. And there's been a huge growth in these ManCos and AIFMs. We covered that in more detail in part 1. If you are serious about Europe, but you don't want to be inside the EU, there is the option of going to the Channel Islands, Jersey and Guernsey. They are very well established offshore and close to Europe jurisdictions. They're in I'm going to use perhaps a term I shouldn't, perhaps a more serious category from a European point of view than the Caribbean. And if you are, as many managers are using private placement, they're very, very commonly used jurisdictions for entering Europe and accessing various investors through private placement. It's a well-trodden route, and they comply. They do all the things they need to do. they've never got themselves into trouble with Brussels in the way that Cayman has in the last few years in one way or another. And so you should be perfectly safe going there and doing what you need to do. Again, domiciliation is a very contentious subject. If people have questions, just come to us and we like to think we can answer them. We've been following the world of fund domiciliation for a very long time. I go back to the days when Bermuda was the dominant one in the Western Hemisphere before Cayman really existed, and Cayman's now completely taken over that role that Bermuda might have had but didn't. Right, we're coming to the end of what I wanted to say, and then we're going to get into the questions. I did mention earlier IFI Global Interactive, and this is a drum rolling moment for us because it's a new thing. It's a new departure very much for us. We're quite excited about it. It is, as I said earlier, a research tool for subscribers. Anyone who happens to be a subscriber can now, we have, as I said, 3 monthly publications, 1 weekly, and indeed our guides, not just our guide to Europe. We do a guide on fund governance and 1 or 2 other things. Anything you find in there, come to us. We will answer those questions on anything you've covered. And we are in effect using our outsourcing our research department, which we like to think is excellent and certainly extremely experienced with a lot of data and a lot of knowledge over decades, not just years. Then you can access that information if you are a subscriber. We can be your outsourced research department, not just on Europe, because we cover, as I said earlier, lots of stuff in the investment area, and particularly in sustainability and in various other areas. And we're covering and following very closely LP allocations in the US and in other guys. Finally, outside the outsourced research department, we have an advisory service for GPs, which covers those 5 items listed down there on the left. Investment structuring, very, 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 very important. You get the structures right, and that really means understanding what the investors you're looking at want. A lot of people come here and they just come with a structure they know, and they're not really fully conversant with what their potential market is looking for. Distribution, we've touched on some of the areas of distribution today. Again, this is areas you can go into an enormous amount more detail, and we have mentioned, but we haven't gone into detail on the European Cross-Border Distribution Directive, but that does need explanation, and then all the business about a reverse solicitation, etc. Service provider and Manco selection, I just touched upon domicile selection, and something that's often forgotten, but we think it's very important, because often you're going to have a board for your fund. If you're going to have a board, you may as well have a good board. It doesn't really cost you any more to have a good board than to have a poor board. And we have done so much work in this area. And if standards of fund boards vary quite dramatically, it's quite interesting. You look at the type of boards. And by the way, I'll give a plug to the Channel Islands here. The boards of the Channel Island funds are by a country mile better than anywhere else. That's because, by and large, they have a large listed sector, and if you're a director of a listed fund, you're hold very much more serious category. You're earning a very good remuneration for that board position, and you're a serious person. And if you take on an offshore or a private fund, you're not going to lower your standards. So they tend to be in a category of their own in terms of the quality. The other end of the extreme, where would be perhaps in some cases. Some of the Caribbean jurisdictions are at the other end of that particular scale, but we can talk about that on a one-on-one basis. And the intelligence service, I've referred Samantha and IFI Global in general does do a lot of information on LP allocations. And Samantha, just an example, I forgot to ask you earlier. We were talking about structuring and the differences, the direct investing that family offices and the other investors are taking. And you just got a couple of examples of that, the sort of thing.
Yeah, I think the main I guess, interesting one would be the Canadian Pension Fund, CDPQ, has partnered with Chinook Partners, which is a natural capital investment manager, to launch a new platform to invest in forestry, wetland restoration, species protection, and carbon capture. So that's obviously a direct example of them sort of pushing for new structures to invest sustainably.
Yeah.
For endowments and foundations, the Packard Foundation invests in New Forest Taft 2 Fund, which is again focused on forestry, biodiversity protection in Asia. And then an example of sort of a direct stake in a company would be Silverstrand, the family office, acquired a stake in an ag tech firm focused on improving the quality of agricultural products and soil health. So there's a lot of activity within this space.
Yeah, it's growing very, very quickly. I can't say that often enough. It's really becoming, and we're collecting all those allocations. We've been doing so for the last, 2 years or something, Samantha? So let's
Yeah, 2 years
do
ago.
questions now, and I know we got a couple already. Do you want to?
Yeah, should we turn to the live ones or the ones that we had?
Whatever you think, whatever you think's best.
Okay. So the first question is there any difference in investor perception of where funds are domiciled within European institutional investors?
Less than they used to be. I think the most important thing is that people meet the qualifications that we've been talking about this afternoon here. Yes, of course, there's a difference between the EU jurisdictions and, say, the Caribbean at the other end, but not as much as there was, I think, is a short answer to that particular question.
Okay, so the next question we have, what are the penalties if the regulator finds that you have used reverse solicitation inappropriately?
That's a very good question. I've been following the subject for a very long time. I personally don't know. I'm not saying, as I said in my presentation, that this hasn't happened, but I personally don't know of anyone who's been caught out by using reverse solicitation and inappropriately and has been fined. But you can lose your license. You certainly can get heavily fined. Depends. It varies by the jurisdiction. It's not the same everywhere, and certainly you can be in big trouble if you are found to have fallen foul of the rules. It is dangerous, and I would repeat what I said earlier. Really does pay to have a good lawyer make sure that you are covered as best as you can.
Okay, so moving on to our prior questions that we have. Now that the UK is out of the EU, is it still possible to use London as a base for European operations?
In as much as, yeah, I mean, yes, but yes and no, in the sense that you could be in Boston, or you could be in Kota Kinabalu. The most important thing is that you are fulfilling the requirements we've discussed in this presentation. Where you are physically, it doesn't make any difference if the fact that you're in London, or even if you're in Paris. It's what you are doing. Are you complying with the regulations in the way that we've been discussing here this afternoon? It doesn't give. The point is, I guess, is that if you're in the States, it's not going to help you from a regulatory or legal point of view then moving to London. It might help you because you're in the same time zone and you can jump on an aeroplane and be in Frankfurt in the same morning very easily, do your day's worth of business there and come back in the evening and all that sort of thing, if you're complying with the cross-border distribution directive, as you should do. So from a practical point of view, it's helpful, probably, or definitely. But from a regulatory point of view, it's not. You've still got to go through the processes of domiciling your fund, picking the right legal structures and all of the kit and caboodle as usual.
So the next question is, We are considering using a third-party AFIM in Dublin, but the costs are considerable and the risk reporting requirements are bureaucratic. Do you have any comments?
Yeah, I saw that question when before it came in. Yes, I do. Yes. One of the things that American managers, by and large, have difficulty getting their head around is the risk requirements under AIFMD. In order for this is one of the big things about AIFMD in response to the Madoff and the whole, not just Madoff, but the whole dramas around 2008. Lots of funds went belly up around about that time. Most famously, Weavering Madoff and some other ones, but lots of other ones that didn't get mentioned in the press as well. And so this EU's way of getting control, if your portfolio management is done in New York or anywhere else in the US, indeed if it's done now in London, let alone the US, you have to have the risk done, the risk oversight management done in the EU. And that's one of the things the Manco does do. And it is that person who wrote that is right. It's a quite an onerous process, but it's the EU's way of getting control of the whole process. So if things go wrong, if there's another major crash around the corner, they've got this, so they can make sure that they are in some semblance of control on the risk oversight point of view. And certainly, sure, the same applies in Luxembourg, but in Dublin. The Central Bank of Ireland, the regulator, can turn up first thing in the morning and ask for various information on positions on whatever it may be, and you have to give that information over in that day or something like that. They do take it very seriously, and that's a bit of a culture shock for US managers. And the same, I'm sure, as I say, applies in Luxembourg as well as Dublin on that. And it costs money. I mean, these people in charge of the risk oversight, these mancos, are paid very large salaries, very, very, and there's at least two of them. Eh? They've got to have, by law, at least two of them, and maybe more. This costs money, so you have to pay for it.
Mm-hmm. So I believe this is our final question. What strategies are European family offices increasing allocations to at the moment?
I'm going to come back to what I've already said. Very much the sustainable sectors, and we in our publication Alternative Investment Strategies AIS have now started to list allocations from these various different professional investment entities into, that's another area, into tokenized funds. We're doing that now, and and I've already mentioned into the sustainable sectors what they're allocating to. The emerging asset classes. I don't think there's much going on in private equity, venture capital, real estate infrastructure. Nothing good or bad particularly. Real estate seems to be humming along, but nothing really significant to say in any direction on most of the private market strategies. However, the emerging strategies, especially renewables, is really growing like beer, which even though renewable performance is not good at the moment, the allocations are, I think I'm right in saying every category we look at, virtually all of them are allocating to renewables in one way or another.
Yeah, I mean, within our environmental investment monitor, 94% of family offices contained in that monitor invest in renewable energy. And it has experienced a 30% growth within the last 12 to 14 months. So they are really interested in this area of sustainable assets. I mean, the second highest category would be biodiversity, nature, and agriculture. Agriculture stands out by far as the focus for investments.
Yeah.
I think it's 54% of family
Wow.
offices allocate to that category. Obviously, the category is quite big, but yeah, it's of interest.
Yeah. Right. Is that it for questions?
Yeah, I think that's it for questions today.
Right. Well, thank you everybody very much for joining us. We're delighted you could do so. There will be, if anyone wants to see it again, a recording of this on our website, just as there was, as I mentioned, for part one. I very much hope you have a good summer, and we'll be back with event. We're about to do some major research in August and into September on GP allocations, and we'll be hopefully back with that into the second half of September. So have a very good summer, and hopefully see you in the autumn. Goodbye, everybody.
Bye bye.